Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. So in this video, we'll be talking about Benjamin Graham, the father of value investing. Benjamin Graham was the teacher of Warren Buffett. And Warren Buffett holds Benjamin Graham in such high regard. Graham, who was operating, I believe in the 30s, he wrote I think the most best-selling popular book on investing, The Intelligent Investor. It's how most do-it-yourself investors are introduced into the market. It's one of the first books they read, and it's really Warren Buffett who just reminds investors, like, always start with Graham, always start with the value investing approach, and then you can grow from there. So Benjamin Graham, he did run his own fund. It was called the Newman Partnership, and he actually had, this isn't as well known, but Graham had a 10-point checklist. And it was actually cited in the book Snowball, which is a book based on Warren Buffett's life. And in Snowball, it said, he, Benjamin Graham, and Walter collected numbers from the Moody's manuals and filled out hundreds of the simple forms that Graham Newman used to make decisions. So at Graham Newman, the hedge fund, they would fill out these forms, and these were essentially these 10-point checklists in order to scale these stocks, in order to rate these stocks to see if they were investable securities for the firm. And so here are Benjamin Graham's 10 points on this checklist. So point number one, Benjamin Graham says this company has to have an earnings to price yield at least twice the AAA bond rate. Okay, number two on the checklist, the price to earnings ratio has to be less than 40% of the highest price to earnings ratio the stock had over the past 5 years. Number three, dividend yield of at least 2/3 the AAA bond yield. Number four, stock price below 2/3 of tangible book value per share. Number five, stock price below 2/3 of net current asset value. Net current asset value is, if I remember correctly, is current assets and you subtract total liabilities. Number six, total debt less than book value. Number seven, current ratio greater than 2. Number eight, total debt less than 2 times net current asset value. 9, earnings growth of prior 10 years, at least a 7% annual compound rate. And then finally, number 10 on the checklist, Graham says, stability of growth of earnings in that no more than 2 declines of 5% or more in year-end earnings in the prior 10 years are permissible. So again, like this 10-point checklist that was developed by Benjamin Graham, this helped him come up with stock ideas then. He was later known to say that the same ways of quantifying these metrics weren't as effective as they were, I believe, in the 30s or 40s, and he was known to say that years later before his death. It's just important to learn about Graham, to read his book, The Intelligent Investor. It's a very good foundation, and to think about how some of these points on his 10-point checklist can maybe still apply today. For example, I still place a great importance on the current ratio, as well as the PE ratio. Not as much before, but you really don't want to buy companies that have a PE of greater than 75, greater than 100 if there's not much growth in that company, you're really still wanting to buy value. Debt, he was very adamant on seeing that companies had little to no debt. And I love it when I see growth companies that have a high rate of revenue growth, net income, earnings per share growth, but then just have no debt and they're growing through free cash flow. That's a really great thing to see. So there are a lot of great points you can still take from this and apply to your own stock picking methodology. So I hope this helped, guys. It was Benjamin Graham's 10-point checklist. If you have any questions about it or anything else, email me at r.speziale@gmail.com or go to my website at robinspeziale.com. Thanks, guys.